Imagine the clamor and intense energy of a traditional trading floor, a place where human voices, hand signals, and paper tickets define the rhythm of financial markets. Now, picture a starkly different scene. A quiet, climate-controlled room filled with racks of powerful computers, executing millions of trades each second. What transformative forces drove this profound shift, and how did it fundamentally reshape the very core of how financial assets are bought and sold? Electronic trading dramatically impacted market microstructure by fundamentally altering how trades are executed, prices are discovered, and information flows through the market. It ushered in an era defined by unprecedented speed, extensive automation, and broad market accessibility, moving away from human-centric processes to machine-driven precision. The core mechanism driving this transformation was the replacement of human intermediaries, such as floor brokers and specialists, with sophisticated computer algorithms and interconnected electronic networks. This pivotal change virtually eliminated geographical barriers and significantly reduced the time lag inherent in manual trading systems. Orders that once relied on shouting across a trading pit or physical delivery of tickets are now transmitted and matched in fractions of a second within electronic limit order books. These are central databases that compile all outstanding buy and sell orders for a specific security. This radical shift led to increased market fragmentation, meaning that trading activity dispersed across numerous competing venues. These include traditional regulated exchanges and a growing number of alternative trading systems, often referred to as dark pools. Dark pools are private exchanges or forums for trading securities that are not accessible by the investing public, allowing institutional investors to trade large blocks of shares without immediately impacting public market prices. This proliferation of venues fostered intense competition, which often resulted in a tangible reduction in explicit transaction costs for many participants. Beyond speed and venue proliferation, electronic trading enabled the creation of highly specialized order types. These new instructions allowed market participants to implement complex strategies automatically, achieving levels of precision and scale that were simply unachievable through manual execution. For active market participants, particularly professional trading firms, this transformation ignited an intense competition for speed. The ability to process information and execute trades even a few milliseconds faster than competitors could determine profitability, giving rise to the phenomenon of high-frequency trading. These high-frequency trading firms deploy powerful computers and advanced algorithms to transact an enormous volume of orders at extremely high speeds, seeking to profit from fleeting market inefficiencies. For retail investors and larger institutional asset managers, electronic trading meant broader and generally cheaper access to financial markets globally. However, it also introduced new layers of complexity, such as navigating fragmented liquidity and understanding the implications of algorithmic trading strategies. Regulatory bodies, often playing catch-up, had to adapt their oversight frameworks to this rapidly evolving landscape. Their focus shifted towards ensuring market fairness, preventing new forms of manipulation that could arise from automation, and managing the systemic risk inherent in an increasingly interconnected and highly automated financial environment. One fascinating, albeit controversial, consequence of this technological arms race is the emergence of latency arbitrage. This is a strategy where traders profit from tiny, temporary price discrepancies that arise across different trading venues, purely due to marginal differences in the speed at which market information is received and processed. Another unique and critical aspect of electronic trading infrastructure is the concept of colocation. This involves trading firms physically placing their servers and computing hardware within the same data centers as the exchange's matching engines. This minimizes the physical distance data must travel, thereby reducing network latency to its absolute minimum. These examples highlight how electronic trading has pushed the boundaries of technological advantage in finance. Ultimately, by comprehending the profound shift from manual to electronic trading, we gain a crucial understanding that this was for more than just a technological upgrade. It fundamentally reconfigured the intricate structure of how financial assets are priced, traded, and settled. This transformation created a faster, more interconnected, and intensely competitive environment, significantly influencing capital allocation, market efficiency, and the overall stability of global financial markets. It underscores the continuous interplay between technology and economic principles.